Thank you for watching this presentation. This discussion is around business succession planning, why you should plan, what to consider and how you go about it.
Planning for the day you leave your business is a valuable investment. Whether you decide to sell up, retire, or you just have to get out of the business due to health reasons, it's important that you spend the time with your family and or your business partners and plan what you're going to do. A succession or exit plan can help you outline what will happen and who will take over the business when you leave.
So why should we be planning though?
Well, a good succession plan will enable a smooth transition with the less likelihood of interruptions to the operations of your business. And by planning the exit well in advance, you can maximise the value of your business and enable it to meet your future needs.
So is this a one-off process?
Well, as time passes and your circumstances may change, you need to make sure that your succession plan is up to date, and it will ensure that you're always ready for an event just in case you need to leave earlier than anticipated. So it should be reviewed and monitored regularly.
When should we start this process? Is this something we do a year out from exiting or 2 years out?
Oh, it really should be considered when you actually start up your business and, thinking long term and when you want to exit. But formulating the plan and the strategy for the exit should begin many years in advance of selling.
Okay, so if we're talking about now exiting our business, what ways are we going to exit, or what circumstances are we talking about?
Oh, well, there's a couple of ways you can exit a business. It's a planned exit, which is the one we'd always like to have, and then, of course, there's the unplanned exit as well. So an unplanned exit could occur due to death or permanent injury, or even because you lose mental capacity. And to ensure that your business doesn't suffer due to one of these events, you should have buy-sell agreements and also personal insurances in place.
Okay, so for more information on dealing with these risks, we do actually have a separate video on business protection, so you can check that one out. What we really want to talk to today is about a planned exit, so planning for a planned exit.
And a planned exit is when you're actually in control of your exit, and the more you put into planning and preparing for this exit, the more you're going to get out of it and be able to retire comfortably. So you should start by setting out your time frame and deciding when you may exit, so how many years off from retirement or wanting to sell up and at what age. And often a question we may get from business owners is, will someone actually pay me for this business? What you need to do is make sure that the business is something that somebody does want to buy. So this may mean you need to improve your financial position and make it more attractive investment for potential buyers.
So what should we be doing then to improve the financial position and the value?
Well, this can all be done as part of your plan by working on and developing your business in key areas such as your revenue, your profitability, debtor control, WIP control, and of course your growth. And these key financial figures are important because these are the sort of things that a purchaser will look into when looking at buying your business. You can also have a look at your systems and procedures, some of your key staff members, and whether or not there is a business without you involved. Because if you're the main reason the business exists, then it may be really hard for you to sell it to an outsider that your customers or clients don't trust. So you'll have to factor this into your succession plan and have a strategy there for you to step back and let others form the relationships, which could be hard for some business owners. This could involve writing training plans and documenting how each task you do day to day is done, and trying to actually become more efficient with what you do.
Okay, so in terms of a planned exit, then what are the options available?
The options for considering who might buy your business, firstly there'd be a family member, and this may be someone who's worked in the business with you for many years and already knows what's happening, and you're going to pass the business on to them. There could be a key staff member who's also worked with you for many years who would like to buy the business off you, who already has established the relationships with clients or customers, or you may sell it on the open market, which may go through a broker. And each of these have advantages and disadvantages and may impact differently on your succession plan. So once again, this should be considered early on in your planning stages who may actually be taking over from you.
Okay, so a key question that we're going to be asked is, what's the business actually worth? So how do we factor that into a succession plan?
Well, the valuation method of your business is also an important step in your succession plan. And if one of your objectives is maximising the amount you want to receive at settlement, then you should focus on ensuring that the valuation is as high as possible. You should understand the components of the valuation method that you choose and concentrate on those areas that you need to improve, like we've spoken about before. And there are different methods to value a business, and it will depend on the type of business you have, which method you actually choose. But you should establish the method as part of your succession plan and monitor each year to see how you're tracking. The valuation may still not be your eventual sale price, as there's other factors that could be involved, such as the economic climate at the time, interest rates, and supply and demand from similar businesses.
Okay, so if we're selling our business, tipping there's going to be some tax implications.
Of course, there's always tax implications, and it should also be another consideration as part of your succession plan, whether or not you could or could not qualify for some of the capital gains tax concessions that are out there. And so there are currently concessions available to small business owners, and these can significantly reduce any tax liabilities that may occur on a sale of a business, possibly even down to zero. So if you want to ensure you qualify for the concessions, then you need to work that into your succession plan as well. And you may need to look at your structure. There could possibly be a need to restructure to get the concessions, looking at possible contributions to superannuation, and the length of time you want to run your business, among other factors. Unfortunately, tax legislation can and will change over time, and this is another reason why you really need to review your succession plan on a regular basis, and it's extremely important due to potential tax changes.
Okay, so if we go through this process and we've done our succession plan, what do we actually end up with?
Well, your succession plan, once you formulate it, should be documented and should take into consideration all the issues that we've spoken about previously. And this document should be then reviewed on a regular basis, or if anything significant happens within your business or externally that affects the business, such as legislation changes, you should also monitor and review your succession plan as well.
Okay, so for more information, please visit our website, www.buscgroup.com.au. There you'll find our business succession planning questionnaire. You can complete that and email it to us, and then we can have a good chat around your needs. Thank you all for watching.
Thank you.